Good morning. This is Ken Hedlund with Somerset CPAs. I'm the principal of our construction team here at Somerset. Welcome to the first program for Contractor MDs. Contractors MDs is a series of presentations and/or webinars by a team of seasoned professionals collaborating to provide timely information to the construction industry. We'll be covering current trends, best practices, and other information for the construction industry throughout the series of our webinar. We have financial, tax, legal, banking, insurance, and suppliers as our experts that will be providing the various sessions. For today's presentation, we are going to provide for contractors specifically a tax reform update as well as year-end tax planning strategies. Speaking today from Somerset CPAs, we have Jay Feller, who is a technical tax partner focused on construction, and also Jenny Ray, a senior manager here at Somerset focused on construction. So with that introduction, I'm going to turn it over to Jay and Jenny to go through the presentation. Just a real quick housekeeping item. The phones are muted, but if there are questions, you can ask questions. There is a feature that you can, a chat feature within the webinar software that you can ask questions. We will take those as we go through the presentation. So Jenny and Jay.
Good morning, everyone. I'm going to go ahead.
Good morning.
Yep.
Ken, you want to talk a little bit about our firm?
Yeah.
I might not heard.
So real quick, again, and you'll get an intro from the other presenters as we go through the series, but a real quick overview of Somerset. You know, our firm was founded in 1960. We have clients in all 50 states. We are a top 10 firm in Indiana, 220 plus employees, 140 plus CPAs, and 33 principals. We do have a construction niche service group, is the area that I focus on, and Jay and Jenny also are a big part of that team that just focuses on contractors. We are also a BDO alliance firm. BDO is you know, the mid-tier, not a big four, but that next tier CPA firm with offices in literally every civilized country, as well as we have the BDO Alliance network, you know, throughout the USA, and Somerset has that BDO Alliance within the Indiana market. And then our core services, again, we are a CPA firm, but we really, from a value perspective, pride ourselves in providing, you know, other types of services from an operational perspective, best practice perspective. You know, we do all the things that you would expect a CPA firm to do, but in addition, you know, with that expertise and that focus on the construction niche area, we have a group of, within our firm, 15 individuals that are 100% dedicated to the construction industry and to the construction community as well.
There we are. Well, thank you everyone for joining us this morning. We have a lot of information to cover, so we're going to move through some of this fairly quickly, but please, if you can email a question if you have one, and we'll stop and go through it at that time. So with that, here's kind of introduction to the 2017 Tax Cut and Jobs Act. In December of last year, the President signed this into law, and we have a lot of interesting things we're going to talk about with this one. Just kind of a quick overview of the business changes. We have corporate tax rate changes, flow-through business income, bonus depreciation, Section 179, all of these things we're going to talk about as quickly as we can. And remember, please stop us if you have any questions. The first thing that some of you probably saw, and it was really publicized with this new tax law is that the C Corp rate went to a flat 21%. The old law where we had graduated rates, we also had some phase out, so it was a huge change is what we saw, and that was the media really played on this part. But what they didn't tell us, they actually are, so for flow-through entities, they went ahead and added a 20% deduction to bring us more closely aligned with the 21% C Corp rate. So with this deduction, we'll kind of get into this. It's called Section 199A. You'll hear people call it the QBID, Qualified Business Income Deduction. So a little bit more about that deduction. It is scheduled to sunset after 2025. There is a bill in the House at the moment to make some of these changes permanent. However, that has not passed yet. Service-related businesses, there's an income limitation, which is around $315,000 if you're married filing joint. I know most of you on the call today, that's not going to be an issue. It does have to be a U.S. trade or business. We have W-2 and property basis limitations, and it's limited to the lesser of 20% of qualified business income or 20% of taxable income minus capital gain income. So we'll kind of break that down for you. Don't write too fast. When we look at that, what we did with most of our clients this year is stop and look at the rates. What sounds really great when the government gave us a 21% rate for C Corps, on the left-hand side of the screen, you can see we have 21%, and if you're in Indiana, the state rate this year ended up being about 5.8. And as an S Corp or partnership, your flow-through income is taxed, what we have in our example, at 37%, which would be the highest rate, and the state rate of 5.25. But what they didn't mention, if you were to take any money out of the company as a C corporation, you're going to also pay tax at a dividend rate of 23.8 for federal and 5.25 for state. If you're an S Corp, though, that doesn't happen. So as an example, what we've shown, or what you can see here, the C Corp on the left-hand side and the S Corp on the right-hand side, both have taxable income of $2.5 million. If we get this qualified business income deduction for an S Corp, we're not going to get that as a C, but an S Corp, we're going to be able to take out taxable income of $500,000 times the tax rate for both entities. And as you can see, the C Corp, though it's taxed at a lower rate, it's paying tax of $671,000. We have cash after that left to distribute to shareholders of $1.8 million. But if they take that out of the business, they're also going to pay tax of 29.05%, which is another $531,000 of tax. And their net cash to the shareholder at that point is $1.297 million after that. As you can see, compared to an S Corp, without that dividend tax, the net cash to the shareholder is $1.6 million. So really, at the end of the day, what we've seen our effective rate for an S Corp about 34.85% and 48.12% as a C Corp. In this example, we have a total tax savings of $331,000. So to get that deduction, that big difference, that $500,000 that we get to take off for flow-through entities, how we calculate that is, first we start with, are you a service business? And in this example, the things that we're going to talk about today, we're not going to include service business income, but there's taxable income. If you are a service business above and below a threshold, we are limited to W-2 wages, and we also have a taxable income limitation. So the big thing on this is the lesser of 20% of qualified business income, or QBI, and then that dollar amount is limited to 50% of your W-2 wages as a company, or 25% of W-2 wages plus 2.5% of qualified property. or after all of that, 20% of taxable income after capital gains.
Real quick, the good thing for all of you on the phone is that you qualify clearly for this deduction as a contractor. We don't think you're going to have any issues about being a business that doesn't qualify. And as Jenny goes through these examples, and because of the amount of wages that you're paying, this 50% limitation of wages, or worrying about how much property cost you have, I think you're going to find that's really not going to be a problem either. The big issue is going to be it's the 20% of your qualified business income or your taxable income. So that's where we're working with our clients to determine how much planning to do at the entity level versus, hey, what is the taxable income? Because there could be reasons that your taxable income is lower, whereas maybe the planning wouldn't be as critical, but most times your qualified business income is going to be higher, so there is some planning opportunities here.
Great, thanks, Jay. Just as a note on some of these, when we talk about qualified business income, that's going to be your ordinary income from your K-1 that you receive at the end of the year from your business. So just an example of how we calculate the 199A. So if you have $500,000 of qualified business income and W-2 wages of $2.5 million, in this example we have $2,500 of capital gains, and then at the individual level, our income, our taxable income before gains is $750,000. So our first step in deciding our deduction, or finding our deduction, is our qualified business income of $500,000 times the 20%, which gives us $100,000. Now we have to see if it's limited, and in step 2, is it limited by our W-2 wages of $2.5 million at 50% is $1,250,000, which is more than $100,000, so we're still okay in this example. And then taxable income before gains of $750,000, we take out our capital gains, and then our taxable income after gains is $747,500 times the 20% of $149,500, which is also more than $100,000. So we do get qualified business income deduction of $100,000. Just to show you where that actually can come into play, where that is an issue, in our next example, our qualified business income is only $100,000. So at 20%, it's $20,000. Our W-2 wages in this example are not limiting us from taking the $20,000. However, our income after tax, after capital gains, is $78,500, and that times 20% is only $15,700, which is less than our $20,000 deduction in step 1. So we are actually limited in this example to $15,700 as a deduction.
Yeah, so what you're trying to do is get to that maximum point where you're going to benefit from the deduction. So in this example, you can see we have a little bit of issue of not getting our full 20% deduction of the 20 grand. And so we would have to do some analysis to look at what could we do by adjusting wages and looking at your flow-through income compared to your taxable income. And over the next month, as we're doing year-end planning, these are going to be the kinds of analysis that need to be done to try to maximize this deduction.
A couple other notes on this 199A deduction. If you have multiple businesses, we have to look at each one of those individually, but there is an option to aggregate and bring those together. It's done by an election, and it doesn't happen in every instance. And then another note is that real estate, since this deduction is only available to active trader businesses, sometimes there's issues with real estate qualifying to be an active trader business, but there are going to be instances where this does qualify.
So to follow up on that, we have done an analysis and looked at very many examples and exhibits that have come out of the regulations. We've run some analysis on our clients, and at this point, it appears to us that aggregating your trader businesses, if you're able to, and that in itself can get a little complicated, you would want to aggregate. And the good news is for contractors is that often you may own the real estate in a separate entity and be leasing it to the operating entity. And if that's the case, the good news is the regulations have clarified that you can combine the rental real estate with the operating activity. And so therefore, you should be able to take this 199A deduction of 20% of your rental real estate income as well, which was a very nice provision that came out in the regulations.
One thing I do want to add real quick is we're going through, what can tend to be somewhat complex information at a high level very quickly. Anything that you have questions on after the presentation, we will be available. We're happy to address any questions you may have. You can contact us directly.
Just a couple other notes when it does come to real estate on this, just noting that they didn't give us specific guidance, but they did point us to a couple code sections that we have a little bit of guidance from the regulations on what does and doesn't qualify. The rest of it you kind of talked about. Commonly controlled real estate, as Jay mentioned, if it's rented to a trade or business, can qualify for the cubic deduction, even if it's not considered a trade or business on its own, which I think will happen in a lot of instances here. Just a quick note, same kind of example, if this is real estate, just to show you what we were talking about with the limitations. The qualified business income in this one is $80,000 times 20% is a $16,000 deduction that we could potentially have. Because we don't have W-2 wages in our rental real estate entity, we are limited by those two numbers, but we also have what's called qualified business assets. The cost of those assets, if they're still being depreciated, we can take 2.5% of that number. So in this case, 2.5% of our assets of $1.5 million are $37,500, and which is not less than our $16,000 deduction that we want to take.
So to follow up on that, it would be if you have a separate real estate unrelated to your business that you're renting some commercial or residential property, a triple net lease, there's a big concern that would not be deemed a trade or business. So that would be something that you would have to look at and maybe renewing your leases when you move forward to do a gross lease rather than a triple net. And so I think that's something that we are really taking a close look at. The good news is, though, that if you can qualify it and have a gross lease versus a triple net, you've got enough property that you could very well be able to get the deduction. And so that is something that really came in late in the process of the new law that allowed, even if you're passive in this activity and not active, you can still take the deduction. But if it's a triple net lease unrelated to your business, then you probably need to do some additional planning.
Just to note that employee income does not qualify for this deduction. And the new regulations are very specific about former employees changing to independent contractors, that's not going to qualify for the deduction moving forward.
So part of this here is that W-2 wages don't qualify. So if you think about your businesses, and depending upon how the ownership is, you would be better to not pay as much wage and flow the income through to you through the S Corp or the partnership if you're a flow-through entity, because there would be an opportunity to take the 20% deduction. Now, questions have come up about, well, can we just reduce our wages without any reason? And that could be difficult if you ever get an IRS exam. So we're really thinking about ways to, why would you reduce your compensation, whether you're slowing down, you're letting other key employees get involved. But again, there technically has to be a business reason if you're going to adjust your compensation down. And so again, that's where we're working with clients as looking at, if we're going to reduce your W-2 comp, why would we do that? Come up with a business reason, and then have more flow-through income to get this 20% deduction, which is a huge tax savings because of that deduction.
And you can also, to some degree, support levels of compensation by position through compensation studies, which Somerset actually does their own compensation study for the construction industry, as well as we have access to national surveys on compensation. That can be a good position for the amount of comp you're paying.
Just a note, we won't spend much time on this, but REIT and publicly traded partnership income does qualify for this deduction and is not limited by W-2 wages or property. There is an option, like Jay said earlier, to aggregate these businesses. It's done by making an election. The individual needs to own 50% or more of each business, directly or indirectly, and then family attribution rules apply. Control is required. And what happens when your qualified business income is less than zero? At this point, what we have to do, the negative amount will carry forward. And if one of your businesses, in conjunction with another, if one has a loss, then the loss has to be proportionately deducted from your qualified business income from your other entity.
And you have to do that regardless of whether you aggregate. So that's why we go back to aggregation really makes sense, because some people said that, well, wait a minute, my understanding is that if you have loss, then you don't have to allocate that loss against your income flow through items unless you aggregate, and that is not correct. Unfortunately, you have to take any loss that is a qualified business loss and take it against your qualified business income. The downside is that they make you take the loss, but they don't allow you to use the wages from that loss entity or the property to help you meet the 20% deduction. But if you aggregate, it does allow you to do that, which goes back to why we think aggregation is a must. But that's something that I think you got to make sure you're looking at each situation to make sure you're maximizing the deduction.
So we're spending a fair amount of time on this qualified business income deduction because it was such a big component of the plan of tax reform. And as you can tell, it's relatively complicated, and there's definitely some strategy behind this, and it's going to be facts and circumstances and case by case. But as one of your contractor MDs, we are available to assist thinking through and strategizing, but it all would have to be typically, like anything, before the end of the year, you'll have to work through these strategies.
Kind of going back to more changes in the corporate tax code, the corporate AMT actually went away. Individual AMT, just as a note, did not. Under the old law, we had 50% bonus depreciation through 2019, and now we have 100% bonus through 2026. It does phase out, and I'll show you, I have another slide after that. The other change is that for bonus depreciation moving forward, under the new law, it can be previously used property that qualifies for this, where in the past, if it was a used piece of equipment, it did not. It just now has to be new to you.
One of the things I've been trying to make a lot of our clients aware of is I think this is a great provision. You obviously can expense just about everything anymore. Jenny will talk a little bit more, I think, about 179 expensing. The only thing we're starting to see with some of our clients, though, and then depending upon what happens with the economy, at some point we are going to have a dip. It's a matter of when, not if. And you got to keep in mind, if we have a down economy in a year or two or three, you're probably going to spend less money on CapEx, and so therefore you're going to have less depreciation from asset additions in the year that occurs, or the couple of years of a slowdown, but you're going to be depreciating these assets for book. And so you're really going to have to plan with your CPA on the cash flow at some point when you have a down economy where things might slow down, and you're looking at your financials that have book depreciation. And then when we look at what our tax depreciation is, we don't have very much left because we've expensed it all in the earlier years. And you may get surprised with taxable income much higher than book income in a year when the economy isn't doing well. And that's going to be critical for you to consult with your CPAs, especially for your cash flow for taxes. So we're just trying to remind people of that now so that you don't get surprised down the road.
Bonus depreciation is scheduled to go down to 80% in 2023 and then 60, 40, and 20. 179, as Jay mentioned, we kind of look at this in conjunction with bonus depreciation for each of our clients. The old law was at $510,000, and now the new law has bumped it up to $1 million limit, and you can purchase assets up to $2.5 million and still be under that threshold.
So going to go back to that one just a second. So some people have asked us, well, why do you need 179 anymore because of bonus depreciation? And the reason is because there are still some leasehold improvement type properties that may not qualify for bonus, and so therefore you can take 179. And then as well, things like roof repairs and big building repairs, as long as a significant repair on a building is really not deemed to improve the building, like replacing HVAC units, major electrical, or whatever, that now will all qualify for 179. That before we would have had to have capitalized it and had to have amortized it over 15 and maybe even 39 years. So the fact that it qualifies for 179, that is new and why that's still important.
Under the new law, net operating losses are subject to 80% of taxable income limitation. They cannot be carried back, but they will carry forward indefinitely. Entertainment expenses are now not deductible at all. They used to be deductible at 50%. And this is something we're advising our clients on, that we need to separate out or separate meals from entertainment, because historically those have gone together.
So go back to that one as well. So again, another issue that's come up is how you define meals. And the IRS has clarified through a bulletin they brought out that drinks are considered meals. So an example would be here locally that if you go to a Pacer game or a Colts game with your client, if you take them out to dinner before or after that includes food and drink, that's still 50% deductible. Or if you have food and drink at the game, it's 50% deductible. However, the tickets would not be. Or if you own a suite at one of those, or the Indians, for example, the suite cost would be 100% non-deductible, but it's critical that you break out the meal and drink portion of that so that you're at least getting the 50% on that. And then just a reminder is that company outings like Christmas parties, summer picnics, those are 100% deductible for any food and beverage. Sometimes people don't realize that, and what we've been doing for some clients is going in and really scrubbing their M&E accounts to really make sure they're not missing, because a lot of times you've grouped a lot of that together, and now it's critical to make sure you're breaking it out between the fully deductible, the 100% non-deductible, and the 50% deductible. So you really need to take a closer look than ever at your entertainment accounts.
The DPAD, the domestic production activities deduction, that was 9% of your income, and most of you, I'm sure, probably have this in the past, that actually went away and was semi-replaced with a 20% deduction.
Because that was only 9%.
Right.
And so you're really getting an 11% additional deduction, which is significant tax savings.
Business interest expense is now limited to 30% of taxable income. Couple notes on that.
It's adjusted taxable income.
Adjusted taxable income, which means plus floor plan interest plus depreciation and interest. So basically EBITDA times 30%, we're going to be limited to that number on our interest expense.
The good news is that we haven't seen that really impact too much because it is an EBITDA calculation, but it does change. I don't know if we have that in there or not. I think in 2022 or 2021, that starts changing where you don't get the depreciation, right, and amortization.
Right, you don't. It's just be limited to income.
May come into play more if you're highly leveraged in a couple of years.
Another note on this one is that it does not apply if your 3 years of average gross receipts do not exceed $25 million. The limitation is calculated at corporate level. And okay, we already talked about next time.
Right.
There is an exception if you're a real estate entity on this interest expense. You have the option to make an election and elect out of the interest expense limitation. If we do that, though, there's a different method of depreciation that has to be used. Okay, so.
All right, no questions, Lori? Okay.
No questions. Okay.
All right.
We'll kind of move quickly through some of these slides because I know we don't have that much time. But again, please stop us if you have any questions. Can I go through some of these? Quick look at the old law and then the new rates that came out, which the next slide is a little more meaningful, I believe. So if you can note here, what we really like to point out is under the old law, the 39.6% tax bracket started at $470,000. And under the new law, the top tax bracket starts at $600,000 and it's only 37%.
And if you look at the brackets and compare them, the good news is not only has the rate gone down 2.6 if you're in the top bracket, it doesn't start until 600 versus 470. And if you look at all the brackets, it's a broadened bracket, so you've got more income getting taxed at lower rates. So on top of this qubit deduction, these lower tax rates also provide a nice benefit.
The personal exemptions were repealed, but they increased our standard deduction almost double. So for married filing joint, the standard deduction moving forward is $24,000. We had some changes also with itemized deductions, and we'll kind of go through each one of these. I have a slide so we can talk. I know not a lot of people qualify until later in life when their income is lower, but your medical expenses now went back to being deductible at 7.5% of your AGI, where it was 10%. The overall limitation on itemized deductions went away. I don't know if any of you were aware, but sometimes when your income hit a certain level, your itemized deductions start to phase out. The state tax deduction or your itemized deduction for state income taxes that you paid and property taxes, real estate taxes, all of those items is now limited to $10,000.
Again, regarding that one, a lot of people were unhappy with that just because of the limitation, because a lot of high income people are paying significantly more than that in state income taxes. And then there's a good chance that you got high real estate taxes as well because you're living in a more expensive home. I'm sure you saw or you've seen the social media, the newspapers out there about some of the higher tax states like California in the West and the Northeast, New York, some of those. They've really been upset about it and have threatened to sue the federal government, which my understanding from talking to people out there in the know is that's going nowhere. However, since the election occurred and the Democrats got control of the House, we are hearing a little bit, is there a possibility that the Democrats may be able to work with President Trump to maybe negotiate something in this area and bump up that corporate tax rate a little bit as kind of a compromise. It's a wait and see. I doubt if anything's going to happen for 18, but we will be keeping an eye on that.
Your home mortgage interest deduction is now your debt on your home is limited to $750,000. This is new debt moving forward. Well, and this, anything purchased after December 15th of 2017. And your interest deduction on home equity lines of credit has been refined and needs to be for a improvement on your primary home. You are currently allowed to take more charitable contributions. They went from 50 to 60% of your income. And if you are one of the people that purchase or that pay charitable contributions to a college athletic, well, I can't even think of the word, where you get
tickets.
You
get tickets for
your donation.
Right.
You
that
get
doesn't
better
work
seating
anymore.
tickets.
Yeah, unfortunately, you get better seating and things like that, and the IRS is going to probably be watching that hard if you get examined, and so that benefit has now gone away for those of you that are doing that for your universities.
The Act also did away with 2% AGI limitations for itemized deductions such as investment management fees, tax prep fees, and unreimbursed employee expenses.
So with this rule, it really, if you can work with your employees to try to do some type of a reimbursement before it's added into their income, because they will no longer be able to get that deduction. And so I think you ought to relook at some of your policies with your employees if you're providing them tools, or if you're not, or if you're saying you got to do certain things on their own, because this is really a negative tax ramification to some of your employees that may have out-of-pocket expenses.
Another big one in that area would be around vehicles.
Yeah,
and vehicle reimbursement policies.
AMT, alternative minimum tax, if you know what that is, or if you understand, we've actually been running two sets of tax calculations for most people. The new act did not do away with AMT for individuals like it did corporations, though it did increase the exemptions and the phase out.
So this is good news, because it is going to cause less people to be in alt min, and I'm guessing some of you have been in alternative minimum tax, and we work with our clients to try to get them out of alternative minimum tax. And so for those of you, and we may talk about it a little bit later, when you get into completed contract percent complete, this becomes an issue we have to address.
Just kind of an example we put together here, because we talked about so many itemized deductions going away, but the standard deduction increased. If you look at my example here, between 2017 on the left-hand side and 2018, the first thing I want to point out is that self-employment and other adjustments in this case went from $207,000 to $26,000, and that was where we found they were getting the domestic production activity deduction of 9%. That was a negative, so our adjusted gross income in the new example is $2.8 million. And if you keep moving down, our itemized deductions stayed the same for charitable, but our taxes went from $291,000 to $10,000. Our interest expense stayed the same, but then our 3% phase out of $70,000 also went away. So in this case, our total itemized deductions went down a little more than $200,000. And I can show you on the next slide. It kind of goes back to, or it shows the same thing at the top. So we go right back to adjusted gross income and the taxable income, or itemized deductions we just talked about. In this case, the total federal taxes in 17 were $882,000, but in 18 went to $961,000. And what I want to point out is, in this example, we did not get the 20% QBID deduction, but I'm going to show you one that we actually do. So when we add that 20% deduction, same thing as the last example, but as you can see where my big smiley face is, we have a $400,000 deduction that we now receive, which is on their taxable income of $2 million. They did qualify. They did have W-2 wages enough to account for $400,000 deduction. And when that happens, at the end, at the bottom, you can see our total federal taxes that were $882 in 2017 went down to $812.
So the beauty of what this example shows is that QBID deduction under 199A more than offsets the loss of the state tax deduction that those of you in high income brackets are really getting hurt by, and by the P's limitation going away, where you get now all of your itemized deductions without any phase out. Those two things combined still show in this example that you saved about $70,000 in taxes from 17 to 18.
Couple notes here. We'll go through these kind of quickly. The tax credits, the child tax credit went from $1,000 to $2,000, and there is a new dependent credit of $500. And the phase out did increase, so this will apply to more people. Same kind of thing. 529 plans can now be used for K through 12. I know in Indiana we have a very nice credit attached to that. We do advise a lot of our clients to put at least $5,000 in a 529 account. Now that can be used for K through 12 public, private, or religious schools. The individual mandate that was attached to the Affordable Care Act went away. The employer mandate did not. Alimony is no longer deductible or includable in income for the spouse. Kiddie tax was increased. The limit for kiddie tax was increased.
Go back to that one again. The only thing we like to point out here, if you've got kids that haven't turned 18 yet, or even if they have and they're in college and you want them to help maybe in the business and maybe use some of their wages to help either fund their college education or to maybe fund a Roth IRA to help them down the road, is that you now can pay up to $12,000 to a child because of the standard deduction that's gone up. And so that's something that we do have clients that are looking at that and saying, hey, my kid is helping out around the business, and so therefore you can really leverage that more than you could under the old law.
Estate tax. The gift and estate tax exclusion went from $5.6 million to $11.2 million. Just a couple planning ideas that we kind of throw out there based on these changes is you want to make sure and do your tax projection now. Don't wait till January when you can't make changes. And you really want to consider looking from the S Corp to C Corp or Schedule C entity structure. Another note here is because we are, not everyone is going to be making charitable contributions every year. Sometimes we're talking about bunching them because your standard deduction is now $24,000. You can gift directly from your IRA to a charity for those of you that have to have a required minimum distribution.
Yeah, so and on top of that, this is, again, you have to be 70 and a half, and we really like this technique because you don't ever have to pick that distribution up at income, and so you don't lose the state benefit that you would otherwise. And also the other planning is because going back to the $24,000 standard deduction that you get. So if you own your home, which more and more of our wealthier older clients do, there's no mortgage interest to get. Your state income tax is limited to $10,000. You're probably not getting the medical deduction because of the income limit. You no longer get miscellaneous itemized deductions, so you're really getting the $10,000 state income tax deduction, but that's much less than the 24 standard. So that $14,000 difference, think about it, if you gave $14,000 in charity every year, you would never really get any benefit because you were already getting the standard deduction if you take the 10 plus the 14. So we have been talking to clients about creating what are called donor advised funds that you can do through your broker that would know how to help you through that, where you can really bunch your deductions, where you could put in, rather than giving $14,000 a year in charitables, you could bunch and maybe give $50,000 to a donor advised fund, use some appreciated securities, you don't pay tax on those, and then you take the deduction all in 1 year. So you might say, well, wait a minute, then how do I deal with my charitable giving each year where it looks like we're not giving during the future years? Well, the beauty of a donor advised fund is you get the deduction when you put it in, but you can advise that fund, who's ever running it for you, to give the distribution to your church or your charity every year. So you're still giving the money, but you're getting the deduction up front. So that's just another thing that we're seeing for people that want to maximize their itemized deductions with charities.
Another planning idea that we kind of touched on before is using your shareholder wages to find the correct balance of wages to income with flow-through entities to make sure you maximize your 20% deduction, and be sure and separate your meals and entertainment into separate categories.
Well, going back to that, just the whole meal and entertainment, what we have really been advising our clients is especially when it comes to the Colts and the Pacers and the Indians and the Fuel, and all the different professional sports teams we have here, or even the college teams around the area, is that you really ought to feel like you're benefiting from that customer prospect contact, because what happens now is you were losing 50% of the deduction and now you're losing 100% of it. So it is an expensive way to try to bring in business and do things. So I think you got to revisit, are you sure those tickets are worth it? And if the relationship is a big part of it, then absolutely you just live with it not being deductible. But the other thing you could do is a sponsorship, where you could still get name recognition. If you go to any of these games, you see where companies are doing sponsorships, and those sponsorships are deemed advertising. If you're not getting any tickets, you may want to rethink, is a sponsorship a better approach, and it would be 100% deductible.
We want to remind everyone to look at the state impact of tax reform. Is different for every state. In Indiana, we really have to look at bonus depreciation in 179 when we take it, because Indiana caps that at $25,000. And I'll go through these kind of quickly because we're running out of time. There is a new, what's called qualified opportunity zone. If you have a gain that you need to defer, we have qualified opportunity zones here in Indianapolis that you can permanently, at some point after 10 years, you can permanently exclude the gain on the investment in the fund if you leave it in there for 10 years.
The appreciation.
Just a quick example of this. We had a contractor client did 100% ESOP in the first quarter of 2018, set up this opportunity zone, had a significant gain from the sale of the business, and set up an opportunity zone to, with this opportunity to potentially, invest in that opportunity zone and totally exclude, if everything is set up properly and to meet the time test, that gain. So it could be significant.
Just a note too, there are now 156 opportunity zone areas in Indiana. The ones here just in our example of, just to show you how many areas there are that you can invest in these opportunity zones. The dark purple, not Indianapolis right there for you. Okay, compliance changes, couple things we want to note on. I'm going to move a little bit quicker because I know we're getting close on time. Like-kind exchanges, where we used to be able to do that for personal property or equipment, we cannot moving forward. It's only for real property. So I think with our increased bonus and 179 deductions that we have available, this isn't going to be as big of an issue as we originally thought it was. The limitations from certain accounting methods and things for tax purposes that historically were $10 million. Some of them are at $1 million. Actually, you've got bumped up to $25 million for cash method of accounting, unicap, and inventory items. Just a note on here, now available to all businesses with gross receipts of less than $25 million with an average of 3 years that are not required to use another method of accounting, you can now be cash method for tax. Under 25 million is an automatic change. These are still available cash method is still available to service businesses of any size, but it's not an automatic change. And the reason we want to talk about this, what does it mean to be cash basis for tax, is you're only paying tax on the income that you receive, and your items or expenses that are paid. And just a quick example on why people want to look at moving from accrual to cash method. This one actually was more than $25 million, but when we calculate the deferral on the left-hand side of the page, our deferred earnings or our accrual basis income included $6.9 million that our cash basis did not. So as you can see on the right, moving to cash basis, if we took that times the highest tax rate, we really moved $2.5 million of taxes paid into the next year. This is a timing difference. It's not permanent, so it does change from year to year. In this case, that company did pay a user fee because it was not an automatic change. But the other thing we want to just quickly touch on is why, if you are cash basis and you consider moving to an ESOP, why that's such a big deal.
Yeah, I mean, the beauty of that is that if you elect to go to the cash method from an accrual method or even a percent complete method, if you're under the 25 million, the beauty of it is that you could sell to an ESOP, which we're seeing more and more of. Valuations are strong with ESOPs if your earnings are strong, and that deferral there of the 2.5 million will never get taxed because an ESOP owner does not pay tax, because it's like an employee qualified profit sharing plan, if you will. Think of it like that. And since everybody's benefiting in the ESOP, so it is a huge tax savings and also significant cash flow savings if you go into an ESOP situation.
Long-term contracts, the small contractor exception is one of those items that went from 10 million to 25 million. Small contractors are allowed to use cash, accrual, completed contracts, or percent complete, but they have to use percent complete for contracts that are more than 2 years. And the only really downside to using cash method or completed contract for contractors, if you're not a home builder, the taxpayer still has to use percent complete for AMT. But just one quick note on there, if you do look, the difference in the top AMT rate and the top regular tax rate is still 9%. So there is still, in most instances, a tax savings.
So you have to do a lot of planning there. And the other thing that unfortunately came out, this CUBID deduction, if you're a contractor and you qualify for it, if we have to use the percent complete method for alternative minimum tax, we have to base our CUBID deduction on your regular tax method. So unfortunately, it really could create some complications. We're saying it's a potential. However, you really got to do some analysis given the potential alternative minimum tax and the potential loss of some of the CUBID deduction for alt min.
Just a couple notes, if you were to move to completed contracts, if you're under the 25 million, the change is done on the cutoff method for contracts starting 1/1/18, and you still, again, have to be percent complete for AMT. So I'm going to add, we've added a couple things after this on our questions. If you do have any questions, please send them to Lori. We're happy to help you. What can you do from here? These are just some quick planning ideas that we have. You really need to review your entity structure from the C Corp to S Corp and look at your tax method of accounting. Does it make more sense to be on completed contract or cash basis? Or for our contractors, there are other exempt methods that percent complete we can use. And just think about tax planning for 2018. What we recommend with our clients is we do a tax projection. For each person, we look at their wages, their year-to-date business income, which is going to include how much of the 20% CUBID deduction that they qualify for. Remember, reviewing your WIP schedule, retirement contributions, and then cash basis planning if that is an option. And the other thing that what we really want to hit on this year, because it is new, is do you have enough wages or assets to qualify for that 20% deduction? And then are you limited by other income or losses that will reduce your 20% deduction at the individual level? And then also remember the interest expense deduction. If you're more than $25 million contractor, we need to make sure that your interest expense is not going to be limited to 30% of your adjusted taxable income. Okay.
Very good.
Well, Jenny and Jay, thank you very much. Wow, that's a lot of information in a short amount of time, and we don't expect anybody to fully comprehend all of this, and accordingly, we are always available for follow-up questions, for strategy around tax reform and year-end tax planning. Happy to help anytime. Also, a couple notes. This presentation was taped, will be available in a combination of places, Contractor MD's site, Somerset's website, We are also happy to send you the presentation via email through a link. So just to make sure everyone knows, we're here to help. Thanks again, and we look forward to future Contractor MDs, either presentations or webinars, and thanks for your participation.